Welcome to This Week in Money. I'm Jim Goddard. We've got a jam-packed show today. Ross Clark from chartsandmarkets.com tells us why the TSX has hit an all-time high. The reason might surprise you. Marianne and Pamela Aden, founders of the Aden Forecast, comment on how world markets are reacting to tariff wars and threats. They also have advice if you're looking to retire soon. Inside Track President Eric Haddock looks at how various cycles are affecting the markets with a focus on interest rates, currencies, crude, and lumber. Talking to us from Japan, James Corbett takes an Asian point of view on what's happening with Trump's tariffs and tells us who would likely win a trade war between the U.S. and China. Plus, at the end of the show, we'll have a company showcase update from American Manganese President Larry Reaugh. We'll talk to Ross Clark right after this.
Hadik Ventures Corp. is a potash exploration company focused on the Cobalt Basin in Thailand, the world's largest undeveloped potash resource. Hadik's management has extensive potash exploration and development experience in Thailand. Hadik will have marketing advantage compared to Western producers. Drill program commences this spring. Hadik trades on the TSX Venture, symbol VCV, and on Frankfurt, symbol V8V2. Visit our website, hadikventures.com.
Aden Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, Aden's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at adenresources.com.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. Welcome back to the show, Ross.
Always good to be with you, Jim.
The TSX has hit an all-time high. Why?
Well, it's made headlines, hasn't it? A little bit of buoyancy in the oil market to help it out, but you know, the biggest plus for the Canadian market is the fact that our currency has just been falling out of bed here. And we got down under 75 cents at one point at the tail end of the week, closing the week a little bit better, more around 75.5. But, you know, when you take a look at it, from the 2009 low coming forward, the big push was into 2011 as far as the Canadian market was concerned. And since then, we've basically just been sideways. We got a broad trading range. If you look at it in terms of the just the TSX itself, it's up about 110% off that devastating low in 2009. If you do it currency adjusted, the peak was in 2011. We have yet to take that out. And as of this week, we're still a good 15% off the highs that happened in January. And most of that is because of the currency side of things. So when investors are looking to place money, clearly the domestic market may look great, but you want to make sure that you've got some funds sitting elsewhere and working, and be where the flow of funds is moving to rather than where it's moving from. And when we look at the Canadian dollar over the years, it's, for all that we might like to think that we're diversifying out a bit, you know, we got cannabis stocks now, and we got Shopify, and, you know, we got a few things other than raw commodity. But it is those base metals, the grains, that really are the driving force for the currency. And any time that you see the Canadian dollar unable to rally with the commodities, which is what we had in the last couple of months, where oil, when it pushed up to 72 and the grains were up around multi-month highs, that Canadian dollar could not match it with the ability to take out any previous interim highs. And so what do? You get that hard break from 78 cents down to 75, and with oil bouncing back at the end of the week, and we can get to that in a second, the Canadian dollar has bounced very, very minimally. So even though it might be oversold, and some of our indicators are sequential, we've had 9 consecutive days with the Canadian dollar down below 4 days earlier, so we're getting into an oversold category. Usually you see an interim low and maybe a bounce within 3 to 4 days, but that bounce is probably a week to 10 days at the most before it starts back down. So a bounce in the dollar, but still it starts to show some resiliency and some improvement relative to the commodity sector. I think the trend still is going to be down, and for who knows how long. You would think that maybe interest rates might be one thing that could help it out, but the employment numbers, the inflation numbers that have been coming out, we had inflation at 2.2% announced at the end of the week versus an expectation of 2.6. So the Bank of Canada doesn't have that impetus to raise interest rates right now, while the Americans have raised theirs, and they've probably got 2 more before the year is over. So from an interest rate differential, the U.S. dollar is still more attractive than Canada. So it's tough to find a reason to want to own Canadian dollars or for foreigners to be moving money here.
In Europe, they say they're going to hold their interest rates steady. Japan, no interest rate now and getting out of negative interest rates. Is that one of the reasons why the U.S. dollar is so attractive? Nobody else
yeah.
has...
I mean, it's the same thing that we're having happen here with Canada. But the euro has had a really tough stretch, pretty much matching the type of movement we've seen in Canada. All of these currencies, whether it's when you look at the dollar index against the basket, or you look at the euro, or even the Australian dollar, which is pretty much an overlay of the Canadian, that they're all just a little overextended right now. But there's no reason to think that after a bit of a pause that U.S. dollar is going to continue higher. And even if there's a tariff war back and forth, the fact is that the U.S. dollar will probably be the strongest of the bunch. And that as far as where you want to be, you need to see something really negative to think that you want to stay with your funds here in Canada.
The Russell 2000 still performing strong?
Well, this we hit good upside targets on that a week ago, both in terms of just the measurement of this triangle that we've been trading in since January. That was a nice breakout about 6-7 weeks ago. We got up to target last week, a week and a half ago. Both in terms of that measurement and also the fact that we had that big measurement off of the 2007 to 2009 break. When we measure that up, the targeted level was at right into where we got to a week ago. So interestingly now, the Russell has started to pause, and we're starting to see a bit of a change in character, and you're getting a rotation. So where these small cap stocks were leading us on the upside, and a lot of that had to do with the domestic side of it, in that the tariff war potentially would be more adverse to stocks that are in the Dow than it would be to the small cap domestic Canadian U.S. stocks. We are now at that point where you're starting to see this rotation, and the defense contractors, which we had overbought in March, are really now, I think, down to like 5-month lows. The website hosting items such as the GoDaddies and Shopify's, Wix, those have all hit extremes and started to roll. The broker dealers, so those would be your Goldman Sachs's and your Morgan Stanley's, those are having trouble, and these have been good leaders. But as they're rolling over, you're seeing now movement into healthcare, consumer staples, real estate. So there's always a bull market somewhere, and you want to, go with that change of flow. It's time for those small caps to take a breather. And we did have this Friday was the big rebalancing for the Russell 1000 and 2000. So the 1,000 are the large cap names, the 2,000 are the small caps. Big volume on Friday, big adjustments happening there as far as the indices are concerned, but that's now behind us.
What's happening with the Chinese markets?
Chinese market, clearly with the concerns over trade, has just taken it on the nose here. Shanghai and the Hang Seng have both taken big breaks. We're probably within literally days here of capitulation lows, but the fact that these things have started to break so badly is putting them into a position where now the margin clerks really have control, and a lot of loans are being called in on investments that have been made in the equity market. So you're probably going to see some good climactic action. You know, we like to always be opportunists, so if it gets oversold enough, I would take a look at the A shares, the ASHR, as a potential item for a pretty good bounce.
Is crude oil going to recover, or is it going to stay the same?
Well, you know, they were looking for the OPEC to come up with an increase of 1 million barrels a day. In theory, that's what they've got, but in reality, they're going to end up with just 600,000 barrels. And for all that the countries that haven't been able to increase, won't be able to increase production because they're already at their maximums, those the potential that could be used there, that additional 400,000, cannot be utilized by the countries that have that opportunity to increase production beyond what the 600,000 will be. So the number came in on the low end of expectations. We've seen the oil market, which I thought could be vulnerable, down to 60. It held at 64 and has really turned the corner here, closing above 69 at the end of the week. I still see that there's pretty good resistance up around the $72 level. So we'll see what happens when it gets up to there. But I don't see us as ready as of yet to have that next major leg to the upside.
Ross, thank you so much for being on This Week in Money.
Nice to be with you, Jim.
My guest has been Ross Clark from chartsandmarkets.com. Coming up, the Aden sisters, Marianne and Pamela, next on This Week in Money.
Always consult your investment professional before making any investment decision.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMY.V, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Arctic Star Exploration, operated by a team of proven mine finders, is focused on diamonds in Finland and the Northwest Territories of Canada. Work programs are underway in Finland and planned for Canada this summer. Arctic Star trades on the TSX Venture Exchange symbol ADD, on Frankfurt symbol 82A1, and the OTCQB symbol ASDZF. Please visit our website arcticstar.ca or call us at 604-689-1799.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. We're speaking to the world-famous Aden sisters, Marianne and Pamela, founders of AdenForecast.com. They're speaking to us from Costa Rica. Welcome to This Week in Money.
Oh, thank you. It's a pleasure to be with you today.
Pamela, can you perhaps just give us a bit of a background for new listeners about the Aden Forecast?
Oh, well, yes, we've been writing the letter for 37 years now, and it's we cover the major markets, stock market, bond market, precious metals, interest rates, and how they all correlate together, and what's best to buy. And what our goal has always been is trying to catch a better part of a major trend, and that's still our goal, of course. And so we fine-tune it. We use charts, and we also use technical and fundamental, both combo and correlations, and so we use how they all work together, because the markets have a correlation, which is also can be very telling in many ways.
I might add too that we also use a lot of leading indicators. So these help us sometimes identify major turns before they happen, and so that's very helpful too, because, for example, if we think there's a major trend change happening, which would be a longer term trend that might last, a year or more, then we'll usually get a little bit of an advance warning on that. And so we tell our subscribers about that and illustrate all of that in our monthly newsletter.
Over the years, have you noticed that with high technology, the markets are more intertwined and more convoluted than ever before?
Oh, yeah, absolutely they are. They always were to a certain extent higher technology, but yes, definitely there's a correlation in the markets, and just the fact that they change tells you a lot too. So yes, like the world markets, the world stock equity markets definitely have a correlation, much tighter now than they did, say, 25 years ago, definitely, and also that they've grown a lot more. So there's a combination there too, technology and growth.
Are we likely to see any summer rallies?
Well, rally, we think maybe before the end of the summer, we could definitely see a rally. And this is what we're seeing, is that this summer is providing some really good opportunities to pick up several markets, actually.
Any in particular that you see?
Well, actually, we see the precious metals, like gold and silver specifically, and selective shares of theirs. We see a very good opportunity to pick up resource stocks, commodities, but actually commodities in the resource sector more than soft commodities. And so we see a great opportunity here this summer, and it just happens to be now, but it's truly, and we could still see lower prices, like, say, in the next month or two, but we see this as a time for investors to focus and get a good price and get a good value. We're having a big summer sale.
We've heard predictions going both ways, the Dow going to 40,000 and others saying it's going to crash. What do you see ahead for the Dow?
Well, the Dow has been, this is, as you know, probably the second longest bull market in history. So it's been doing very, very well for 9 years now. And as far as having it go to 40,000, we don't think so. And one of the main reasons why is because the interest rates are inching up. And so eventually that's going to put a little bit of a brake on the stock market, and it already is a little bit, but not quite full on yet. And we just think the stock market overall, it's still bullish. Technically, it's still in a bull market, which means it could go higher, but it's starting to look a little tired. So if you wanted to just make it simple, you could say there might be some upside left, especially in some of the tech stocks and the small caps, but basically, the overall market is probably in the 8th inning, maybe even entering the 9th inning, so it doesn't have a whole lot of upside left, it looks like.
Over the last few months, we've seen record stock buybacks. Has this been kind of an unofficial quantitative easing?
Well, you could say that. They're trying to keep their stock up, you could say. And yes, you could say that, but and they believe in their company, of course, and they're keeping it up. So you could say that indirectly, but that can only last so long. What's interesting, too, is that the Russell 2000, it's always been called, back in the day, they don't call it that anymore, the cats and dogs of the industry, which is the small caps, of course. And usually they tended in the past to have their huge rise at the end of a bull market. And and that's what we're seeing now. We're seeing a very strong small cap rise, especially in the last several months. So it and the NASDAQ hit record highs recently. And so we don't know if that's the same indicator it was in the past, but we're certainly keeping our eyes out, being it that we're in the 8th or 9th inning. But yes, it is an important market to watch right now, we would say. Russell 2000, NASDAQ that's been incredibly strong. Those are the two, like, super strength. The Dow has been pressured from the tariff tensions and fears of trade wars. So the Dow is being a little more vulnerable than the industrials are a little more vulnerable.
Are the small cap stocks more attractive towards the end of a bull run because they're more affordable?
Well, they could be, yes. It could be very much so.
General Electric was removed from the Dow after more than 100 years on the listing. Should we care about its removal?
Well, I think that's just a sign of the times. I think within the 30 stocks in the Dow that make up the Dow Industrials, they try and make it the biggest value stocks. And so they're just replacing things. We don't think it's a major item to worry about or not worry about.
How are the world markets looking right now?
They're actually still looking very good for the most part. They generally, the bull market, it's been a global bull market. They've all been moving together. But just recently we've been seeing some cracks in some of the emerging markets, some big cracks in a couple of them. So we are watching this just in case it is a warning and that they may be leading the other markets down. It's still too soon to say if that's the case, but it's something we're watching.
Is the monetary crisis in Argentina and Venezuela likely to spread to the rest of the planet?
No, they've had their crisis over the last 30 years. In the 80s, they really were in big crisis, Argentina. And no, it stays localized because it is a local thing. And so, no, we don't think that's the beginning of a spreading.
Is President Trump bullish for the U.S. markets and economy?
Actually, he has been. He has been very bullish for the stock market. And for the economy, so far so good. Yes, there's still a lot of looking under the rock darkness there, but certainly the markets have responded positively to him.
I just wanted to add on that. He has been, but right now what's happening with the tariffs is not bullish for the economy or the U.S. market or the global market. So this is kind of a new development in just the last, say, couple months or so, and especially just in the last couple weeks. But the trade tensions, if they continue, they will not be bullish for the stock markets or for the economies either. So I think that's one thing we're watching now very closely, because the markets, you can see, especially this week, the last 10 days or so, they're nervous about it and they're worried. And so when that happens and there's uncertainty, it's also a sign of caution.
Could these tariffs trigger an all-out trade war and following that a recession?
Yes, it's absolutely possible, and hopefully it won't get to that point, but we're kind of heading in that direction, and hopefully it can be averted. But if it continues on the trend, this new trend it's on, then it could certainly eventually lead to a recession.
Are tariffs not really targeted at a country because when it's all said and done, the people who pay the most and suffer the most, are they not the consumers?
Well, ultimately, yes. Things become more expensive. It upsets the apple cart, and I don't know. I think it's something like 70% of the major corporations have already come out and said this is going to hurt the consumers. It's going to hurt us. And so it's just not a good thing overall.
Another thing I might add is that with the overproduction in the world today, like it's been for a while, the adjustments will say, like one country could say, well, if I can't get it here with a tariff, I'll go over here and get it. So in that sense, there will be some adjustments in the world and how they export to each other, import to each other, from each other. So that could happen too. So there's going to be a big mix if this continues. And it's certainly not good for anybody, the economy or the stock market.
We'll have more with the Aden sisters next on This Week in Money.
I'm Brian Fowler, president of Blind Creek Resources Limited, listed on the TSX Venture Exchange, ticker symbol BCK. Blind Creek is focused in the Yukon, Northwest Territories, and British Columbia. The company's key property is the Blend Project, one of the largest undeveloped lead zinc silver deposits in Western Canada, plus plans to advance the recently acquired, fully permitted historic engineer gold mine in the Aden district of northwestern BC. Check us out at blindcreekresources.com.
I'm Greg Johnston, CEO of Carl Data Solutions, an industrial Internet of Things company that provides big data solutions for monitoring critical infrastructure. Carl Data offers machine learning and predictive analytics features through our cloud-based applications to deliver key asset-saving operational insights from massive amounts of data. Carl Data trades on the CSE, symbol CRL, and the Pink, symbol CDTAF. For more details on Carl Data, please visit carlsolutions.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. We're speaking with the world-famous Aden sisters, Marianne and Pamela from Costa Rica. They're the founders of AdenForecast.com. Pamela, we keep hearing that China will soon overtake the U.S. to become the world's leading economy, yet the U.S. economy is still twice the size of China's. Does it make sense that China is about to become the new leader?
Well, you just said it right there. The fact that the U.S. economy is twice the size of China, yes, China has grown a lot in the last 25, 30 years, and it's going to continue growing. But they're far from the middle class being just like the U.S. middle class. They're far from being a truly developed country. But at some point in time, yes, they could take over, but we don't foresee it for at least for another 10 years, say, or probably more.
Is it true the U.S. middle class is disappearing, or is that just a lot of whiners on social media?
No, it is. We have the numbers. I don't have them handy, but the numbers show that the rich are getting richer and the poor are getting poorer, and the middle class is being squeezed. And that's not a good thing for the U.S. economy. It's not a good thing for any economy. And part of that has just been due to the credit cycles, all the QE programs that so many of the central banks have been involved in, and a number of other factors. But it's a growing discrepancy, and it's not healthy.
Should the tax cuts have focused more on the middle class?
Well, it would have been very nice, but they didn't, and so again we see the average working man being squeezed a bit, and the benefits going to the higher earners, and it does help the economy in many ways, but it also squeezes the middle class a little harder.
Has the economic cycle been replaced by the credit cycle?
It has. It has. I'm sure your listeners know the old economic cycle was usually, not always, but generally a 4-year business cycle. And now we've had, with central bank intervention and lowering extremely abnormally so low interest rates and the QE programs and pouring a lot of money in, making credit so available, so much money going into the systems, that has kept boosting, for example, the stock markets, the asset markets. And so now we have the credit cycles that have become more dominant, far more dominant than the business cycle, which has kind of moved to the back burner, so to speak.
So I'd like to add that the financial crisis of 2008 changed a lot of the dynamics of this, and it's still the one in control. Interest rates are the one that really moves the markets and which way they're headed, for how much, and so that is what has replaced everything else.
It looks like the new Federal Reserve leader, Jerome Powell, will continue to raise interest rates. Is that likely to hurt U.S. markets and the economy?
Well, it's interesting because the Fed usually is the one that follows the free market, and so they will do everything they can to keep the peace and keep things going on that end of what they're responsible for. So yes, they could continue raising rates. Like the Fed funds rate is, as Dick checks, of course, is the short-term interest rates, and they have been rising a lot faster than long-term rates. And in fact, they're getting closer to them. They're starting to meet. They're getting close. They haven't met yet, but they're getting there. And if this continues, where the long rates are kind of moving flat like they've been lately, and the short rates continue rising, if they go higher, that's not good at all for the economy. That itself usually means a recession is coming. We're not there yet, but it's something we're keeping an eye on, and everyone should, because they are very close. But it looks to us like rates will still start rising, but there's nothing. If you look at history, a lot of the history of the past, you can see long rates, a 10-year rate that usually dictates the mortgage rates, and they're actually the most important rate. There's nothing to say they can't just move within a 1 or 2% a sideways band for several years and still be kind of heading up. But if they do that, it really won't hurt that much of anything. It won't be a big negative. It'll be just a neutral okay. So we don't see that rates are going to hurt soon. Eventually, depending on how it goes, it can. But for this year, next year, we don't see it really having a big effect on the market.
Have American consumers taken on a lot of debt, perhaps too much debt?
Yes, they have, and the debt just overall is, and this is talking consumer debt, student debt, government debt, corporate debt. it's all gone kind of through the roof. And I think the last numbers we saw was something like the average family of four owes something like, when you consider all debt, $800,000 per family in debt. And so it just keeps growing, and everyone keeps saying they're trying to bring it under control, but it never happens. It just continues on, and where it's all going to end, really, no one knows. But it is a bit worrisome, yes.
What would happen if everybody declared bankruptcy?
Well, that's to be seen what happens there. Not a good sign, obviously.
Is real estate in the U.S. getting into bubble territory again?
Actually, as crazy that sounds, we don't think so. I mean, it doesn't mean it has to keep shooting up to the moon, and especially in certain big cities that are just so off the charts of high, because there is a basic shortage of housing, and the interest rates, if they stay relatively low or kind of move within that band that I just mentioned, there's nothing saying why real estate can't continue moving up. And maybe not at break levels high, but, the tendency is still up.
Both Canada and the U.S. have record low unemployment, and yet there hasn't been a huge demand for pay raises. What's going on there?
Well, I think that's coming, because we're already seeing inflation perking up a little bit. Not worrisome, but it is moving up in an uptrend, and we do have pretty much full employment, and unemployment something like 50-year lows. But eventually, if prices start inching up, continue inching up, because they already have been inching up, but they're just coming up from such low levels, it's not really that noticeable. But once it does become a bit more noticeable, then I think you will start seeing the demand for a higher pay.
Is the bond market in trouble or in a bubble?
Well, again, we think the bond market right this moment, it's been like for a couple months now, at a critical juncture of a mega trend. So we're like at a really important turning point or not with the bond market. And so far we don't think the bond market's in a bubble. It's been rising since 2000, a general uptrend since 1981. But it doesn't, while it has signs that it's over, it's not completely over, and so we're still watching to see that. We're not in bonds, but we're watching them closely to see if they turn. And so far, they're still on the fence.
Does the Trump administration prefer a weak dollar policy?
Yes, we absolutely think he does. That's what he likes. That's what he wants. And that's what he got last year. We'll see about how long this rebound rise lasts, but it doesn't look like it's going to be that long lasting. We think he's going to end up getting what he wants.
How are world currencies holding up against the U.S. dollar?
Well, there's a mixed bag there. Basically, this year, they had a nice rise, of course, all of them last year when the dollar fell, and so did other markets got a good boost upward too. But this year, with the dollar rebounding, what's been mostly felt hard is in the commodity currencies, like the Australian dollar, Canadian dollar. Those have been more hurt this year with the stronger dollar because the resource sector was hit just more recently with trade. But like the euro, while it fell, it's holding. The yen is being used as a safe haven lately with all the tariff tension. So the yen's been holding, granted at a lower level, but still holding compared to the others. And the Swiss franc too, for that matter, and the British pound to a lesser extent. So there is a mixed strength in the currency markets, but once this rebound rise we see in the last few months is over, we think then these currencies will definitely pick up, especially with the resource sector bottoming out and starting to rise.
President Trump and the art of the deal. He says he's imposing tariffs to even out trade. Once trade is evened out between countries, could all tariffs be easily removed?
Well, I think that's not as easy. It's not as easy as it sounds. I don't think the day will come. A lot of resentments have built up, strained relations, and it's not like everyone's just going to happily say, okay, let's all take all our tariffs off. I mean, it could happen. It's not impossible. But generally speaking, it doesn't sound very realistic.
It's just like taxes. Once a government imposes a tax, how often do they remove it?
Exactly. Yeah. No, that's true. And it's like you'd like to think, gee, yes, we'll take these off after a while. But it seems like this is more kind of new wave that's going to last for quite a while.
Gold and silver continue to be in a long-term trading range. What do you see ahead for gold and silver?
Yeah, it seems like they are. They actually have been what we call, for the last 2.5 years, they've been in a turnaround time because they've been slowly rising, especially gold's been in an uptrend since December 2015, its low when it reached its ultimate low. And silver has been a sleeper. That's what it does. That's in the past. That's what it always does. It kind of sleeps till it wakes up and then it takes off. But we think that this summer actually being a good buying time, and we'll see how much strength it has from here to year end. And depending on that strength will be that we're out of this turnaround time and into a full-fledged bull market. This is what we're looking at right now. So we see that silver already kind of showed that it wanted to break up about a month ago, and it looks like once the resource sector turns around, like surprisingly, I think many people don't realize how strong copper has been in the last couple of years compared to even the stock market. Just comparing year per year, it's actually outperformed the S&P, and it certainly has kept up more than that. So even though it's come down this past month, it's clearly telling us to be buying it, and once resource starts rising, then we'll see silver really take off. So we think silver has better potential than gold looking over the next couple of years.
Could gold, silver, and the U.S. dollar run higher together?
They have in the past, and they can for a time, but eventually they end up moving opposite. But there's nothing saying they could move together or kind of muddle through moments for 6 to 8 months or so. But long term, they did tend to move opposite.
Is copper still a good economic indicator?
Yes, it is. It's a great economic indicator. It's still in its doctor role. It does tell us a lot about the growth of the global economy, the strength of it, the health of it. So yes, copper is a very good indicator.
Are gold and silver shares cheap for the big caps, mid caps, and the juniors?
Yes, they are totally wiped out versus gold itself. I mean, historically, looking at the last, say, 40 years, and they're totally bombed out and have been. Even though they've risen in the last couple of years, they're still in very bombed out territory. And yes, there is some really good ones to pick up and hold. And it's not just buy anything, but yes, there are some good ones there to buy and hold.
What do you see ahead for crude oil?
We think it's in a major uptrend, just like copper is. It's even stronger. It actually led the way. And we see that there's really nothing competing with oil in the foreseeable, say, next decade. And there are alternative energy, but it's certainly not going to replace oil. This is still a very oil-hungry world, and it doesn't look like it's going to change anytime soon. So we see, and the way they've been holding their production, the OPEC, and the way everything's been working with Venezuela, with everything, with the U.S., we think that oil and energy have a very good upside.
What sectors do you like going forward?
What sectors do we like?
Yes.
Well, like we mentioned, we like the resource sector, we like the energy sector, we like the precious metals, meaning gold and silver, not necessarily platinum and palladium. And we like selective shares in that division. We are in some tech shares, but to buy them today, we wouldn't do that. But if you have them, we'd hold them. And so those are the sectors that we like right now going forward.
A lot of people are looking at retirement right now and are heavily invested in the equity markets. What advice would you give them to make sure that they have a secure retirement?
Well, that's a great question, and it's very important at this point, considering the stock market probably is getting a little long in the tooth, the bull market. And if you're a baby boomer or you're in retirement and you're heavily invested in stocks, it doesn't sound very nice to say this, but the truth is you're not going to probably want to be around to see a bear market unfold, ride it through, and then come back to break even, because as you know, that can take 10 years. It can take, much longer than people have. So our advice is to keep stop losses, a good buffer. It could be like a 15% from where the price is now. Some people say 20%, but have some kind of a stop on your positions so that if the bull market does turn down and we do get a recession and we do get a big bear market, you're stopped out, you've made your money, you put it aside, and you're not going to ride the big bear all the way down and hope to have, that you'll be around to have it come back up and break even. And so that's, I think, very important advice, especially for people that are older. Now, if you're younger and you've got more years to live and you don't mind riding through a bear market and having it come back and holding for the very long term, that's fine too. But at this point, only because the bull market is getting mature and we're nearing a major top, then I think this is a very important kind of an age-defined difference that people should pay attention to.
How can people find out more about the Aden forecast?
Well, for your listeners that are interested, we have a little offer that we would like to provide them. If they were to write info@adenforecast.com, and we will send them a complimentary issue of our newsletter and a weekly update, and they can try our product out and see if they like it.
It sounds like a good offer.
Oh, thank you.
Thank you so much for being on This Week in Money.
Well, thank you for having us. It was truly a pleasure.
My guests have been the Aden sisters, Marianne and Pamela, founders of the AdenForecast.com. They were speaking to us from Costa Rica. Coming up, Inside Track President Eric Haddock, next on This Week in Money.
I'm Kelly Jennings, CEO of PowerBand Solutions. PowerBand is a cloud-based provider of auction, inventory, and finance solutions that make buying, selling, and financing vehicles more efficient. PowerBand Solutions trades on the TSX Venture Exchange symbol PBX and on the OTCQB symbol PWWBF and on Frankfurt symbol 1ZV. For more information, please visit us at powerbandsolutions.com.
Cypress Development Corp's flagship lithium project is located just east of Albemarle's Silver Peak mine in the heart of Clayton Valley, Nevada. A 12-hole exploration drill program for lithium-enriched claystone on Cypress's 100% controlled properties is now underway. Cypress Development Corp trades on the TSX Venture Exchange symbol CYP, the Pink's CYDVF, and on Frankfurt C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. I'm Jim Goddard. We're speaking with Eric Haddock, president of InsideTrack.com, also InsideTrackTrading.com. He's speaking to us from the Chicago area. Our conversation is taking place on Thursday, June 21st. Welcome back to the show, Eric.
Well, thank you for having me back, Jim.
Eric, it sounds like the Federal Reserve's plan is to continue raising interest rates, even though other central banks, like the Bank of England, have decided to stay at their current rate. Does this fit in with the interest rate cycle?
Yes, very much so. And to really put that in context, I would start with just reviewing the longer-term cycles that I know we've talked about in previous interviews. Those cycles were cited back in 2016, projecting a multi-year top in bonds and a low in interest rates that would arrive an exact 40-year cycle from 1976 when rates bottomed and entered a parabolic rise. And that particular low in interest rates was an exact 40-year cycle from 1936 when rates similarly bottomed and entered a sharp rise on a sudden turnabout in Fed policy. In fact, that interest rate hike or that tightening by the Fed led to what really would have been the worst stock market crash of the 1900s if it weren't for the 1929 to 1932 crash. But the crash that began in 37 on the heels of that tightening had another devastating impact on the economy, which, really wouldn't recover until America got into World War II. But so you had both those phases of the 40-year cycle, a 40 and an 80-year cycle, but also 2016 was an exact 70-year cycle from 1946, which was the lowest level of interest rates in the entire 1900s. So 2016 was a strong convergence of those multi-decade, even multi-generational cycles from the three most dramatic interest rate reversals of the last century, and that was forecast to trigger another big reversal in interest rates and an expected sell-off in bonds that I still think will last into late 2019. Shortly after bonds peaked in 2016, you had the Fed begin this whole cycle of tightening. So once again, the fundamental driver came right after cycles and technicals had peaked and validated what they were already saying. On a little bit more of an intermediate basis, though, which I'm sure listeners are more interested in right now, bonds were expected to bottom in early 2017, bounce into September of 2017, and then see their next bearish phase lasting into mid-2018. So we're right into that now. Bonds have fulfilled weekly and monthly cycles, and a multi-month bottom is expected right in this time frame. But I still do think there's a third shoe to drop in 2019, which then would be expected to drive bond prices down into the second half of that year.
Do interest rate cycles affect the bond market cycle?
Very much so. They're really two sides of the same coin, with the price of bonds showing an inverse relationship to the level of interest rates. Often at their extremes or at their culmination, those interest rate cycles can often impact other markets too, like equity markets. It's interesting to me that with some of the longer term cycles, that when I'm talking about the bonds seeing a third phase down into third quarter of 2019, that's also a specific time frame when stock market cycles show some of the greatest vulnerability. So much like we've seen a couple times in the past couple decades, that when you get a market like bonds reaching the culmination of a down move, that's when all of a sudden you see it impacting another market arena like equities.
The U.S. dollar is strengthening. Is this trend likely to continue?
I think that we are getting ready to enter more of a period of consolidation. If you recall back in 2015, 2016, some of the discussions we had, I was focusing on long-term dollar cycles and why I thought that the dollar would see a multi-year peak in late 2016, early 2017. And that one of the conclusions I had back then was that it would likely be an omen of a Republican administration coming into office in early 2017. And that was just based on the ongoing correlation that we've seen the last 40 or so years, where Republican administrations tend to favor a weakening dollar, and the opposite for Democratic administrations. And there were a lot of other corroborating cycles at that time. But the outlook from there was for the dollar to decline into the second quarter of 2018 with a 1 to 2 year downside target around 88.5 to 89.5 in the dollar index, and a contrasting upside target in the euro of 126 to 127. But that dollar target was a complete 50% retracement of the 6-year advance that it had seen between 2011 and 2017. And it was also the level of the two most significant prior highs in the dollar before they broke out to the upside. That's kind of a technical pattern where you will see previous resistance turn into support and vice versa. But all those things came together around 88.5, 89, and that was the 1 to 2 year downside target in the dollar, which it actually reached in mid-February, a little bit sooner than when I saw cycles turning back up. But that bottom was expected to hold for 6 to 12 months once the dollar reached it. So we've been in that rebounding phase from there, and the 2 to 3 month upside target from there was around 95 to 96, which the dollar has just spiked above 95. So we're reaching extremes on the upside now, which just tells me we're probably going to see probably a 3 to 6 month period of congestion take hold in the third quarter and fourth quarter of this year. And a secondary low could wait until early 2019. Is the euro in an inverse cycle to the U.S. dollar? For the most part, I would say yes, particularly since I'm usually viewing the euro in terms of the dollar, so that just is a given. But there are times when another currency could suddenly take center stage, whether that be based on interest rate or intervention policy or some other economic surprise or shock, and the dollar and euro could move in tandem, but those types of anomalies are usually short-lived. Even the recent interest rate announcements seem to corroborate that too, where you have, the Fed just last week reaffirming its stance of continued tightening, that could expect several more interest rate hikes over the next 6 to 12 months, and then the next day the ECB announces there would be no interest rate increases till 2019 at the earliest. So there definitely is a strong inverse correlation going on there. We're speaking with Eric Haddock, president of InsideTrack.com and also InsideTrackTrading.com. Eric, is there likely to be continued weakness in the Japanese yen? On a near-term basis, that really hinges on whether the yen can hold above its recent May 2018 low, which came into play right around 90.50. I'm looking at the yen futures, but that is a pretty significant level to me, and I do think it's a pretty good possibility that the yen is going to hold above that and spur a rally that could last at least into August of this year. One of the key things in the yen is that, in contrast to the euro, to the British pound and Swiss franc, and even to the Canadian dollar, the yen has held above its year-opening lows of 2018, which is a key range of intra-year support for any market. And whereas all those other currencies I mentioned quickly broke below their the lows of the first few weeks of 2018, and that triggered intra-year downtrends in those markets, the yen actually rallied much stronger from its January levels and is only now coming back to retest that opening range. So that's a pretty good sign of some underlying resilience in the yen, at least in comparison to the European currencies. It's something that should probably underpin prices and spur a new rally in the coming weeks. And as I said, the risk is a daily and a weekly close below 90.50, which is where the intermediate outlook would be considered wrong, and I'd have to kind of reassess things at that point. But I think the yen has been showing signs of a slowly developing bottoming process, but it needs to really trigger some more signals to indicate that it's ready to enter more of an impulse move higher. What about the Canadian dollar? What's it going to do? The Canadian dollar has been certainly showing some more weakness as of late, but I also thought that could be seeing a bottom mid-year and seeing some recovery in the third quarter of this year. The Dow continues to be trading in a range. Where is the Dow in your cycle? One of the most consistent cycles that I've been discussing with you and with others over the last year or two has been a 5-month cycle in the Dow and in the stock indices, and an overarching 10-month cycle. Both of those cycles were expected to invert and time a multi-month peak in late January of this year, which took hold right in sync with those cycles. The top in the Dow came 5 months from its late August low, and what that inversion does in my work is tells me to look for a series of subsequent highs on that same approximate 5-month cycle basis. And so I have been looking for the equity markets to set another multi-month peak in the second half of June, 5 months from second half of January when they set that preceding peak. And we've got a lot of price and technical indicator action already corroborating that. One of those things is with the Dow just turning its daily trend down in recent days, and meanwhile the NASDAQ 100 continued to forge higher, and the 1 to 2 month upside target I've had in the NASDAQ 100 futures is right around 73.50, where its rally since early April would match the magnitude of the February-March rally that it had. And if it only matches that rally, that's a little bit more of a, in some respects you'd call it corrective, but since it's going to the upside, that's a bit of a misnomer. But it's something that shows the market's less likely to break out and accelerate higher. So we've actually just seen the NASDAQ 100 test that 73.50 level this morning, just in the last couple hours. And I wouldn't be surprised to see signs of a peak start to take hold here in the waning days of this week or early next week. So we're definitely living on borrowed time, and I think that the overall equity complex is getting ready to see another 4 to 8 week correction, something that could be on the magnitude of what we saw in January, February, and some indexes stretching into late March of this year.
Gold and silver are becoming more volatile, yet remain in a trading range. Is increased volatility a precursor to a breakout move?
Not necessarily. In fact, markets sometimes begin to narrow their ranges shortly before a breakout move. In contrast to that, wide swings within a trading range are more signs of congestion, something that can go on in a market for upwards to a few years. Leading into this year, coming into 2018, I said that I thought gold would have its best rallies in early 2018, which would lead into a multi-month peak in late January, and also in late 2018, leading into a multi-month peak somewhere between mid-November and mid-December of this year. So that was when I thought we would see the two best rallies and consequently also the two most significant peaks take hold. But in between there, a lot of volatility was expected with certain specific indicators used to hone a more specific price outlook for gold in the middle half of the year. For instance, one of the key things of recent history was my work had projected an intervening intermediate top in mid-June, but when I was coming into this year and in early 2018, I didn't have enough specific work to say whether that mid-June peak would be higher or lower than the expected January 2018 peak. It wasn't until May, when gold turned its weekly trend down, that it clarified that outlook. And since mid-May, my publications have just kept emphasizing that gold should rebound into a lower high in mid-June, even as silver was poised to retest or even spike above its April peak during that June 11th to 15th time frame when weekly cycles were expected to peak and trigger the next leg down.
Does the XAU cycle precede the gold and silver cycles?
Some of that depends on the direction of the trend or the extreme that you're approaching, and by extreme I mean the high or the low. When a multi-month or multi-year top is in the making, the XAU often peaks first, which you could argue is showing underlying weakness. 2010 was a perfect example of that when the gold-silver index peaked before the metals. They peaked in 2011. On a multi-month basis, February of last year, February 2017, was another example where the XAU peaked in early February and then moved progressively lower throughout the year, even though gold continued to forge higher and set a series of higher highs until September of 2017, 7 months later. Similarly, when a bottom is coming, the XAU often lags gold and silver, and I say similarly because I mean it's similarly showing relative weakness compared to the metal. Even though it bottoms, it lags, and it tops, it leads. A perfect example of a little bit of an anomaly there was the move from May into June. Silver set its bottom in early May, and it was projected to match the timing or the duration of its December-January advance, which had unfolded over a 6-week period, more precisely 44 days. From its early May low, that projected silver to rally into June 11th to the 15th, and more specifically into June 14th, before a new wave down would be most likely. The intriguing thing about that June 14th date to me was that not only would it exactly match the duration of 44 days that the December-January advance unfolded, but it would also be exactly 20 weeks from the January 25th peak, and that 20-week cycle is what has been governing gold and silver for a couple of years, and it's why I came into this year looking for those peaks in late January, a secondary peak in mid-June, and then a higher peak in somewhere around late November. The interesting thing about this recent case was that the XAU moved in lockstep with silver and also forecast a rebound into June 14th before its intra-year downtrend was expected to resume and ultimately drive it lower into the third quarter. In fact, in my June Inside Track monthly newsletter, which was actually written at the end of May, it restated this whole outlook and the myriad of cycles that are converging in the third quarter of this year in the XAU, and why that is the most likely time, I think, for a very significant low there. It was expected to see a rebound into mid-June and then a subsequent sell-off into July or August, which has been validated by the action of the last week.
Eric, what do you see ahead for crude oil?
I think that crude is probably going to see some developing congestion. A lot of the outlook coming into this year, which was based on some weekly and monthly cycles that have been pretty consistent in the oil markets, it projected a trio of important peaks, first one in late January, then one in mid to late May, and then a third one in August. Crude fulfilled the first two and then turned its weekly trend down after that May peak. So that told me that we should see a period of consolidation for a couple months, even as it prepares for another high in August. From a price basis, crude's initial downside target after it peaked above 72.50 was to see it drop to about 64.5, and it's reached that level. It's spiked below it a couple times, but is showing some support there, so a multi-week low could be taking hold.
The lumber market's important to Canada. Could trade concerns with the U.S. cause dislocations in the lumber market cycles?
As far as the lumber cycles go, I've really maintained one long-term outlook for the past several years, and that was that lumber would see an overall major advance up to unprecedented levels leading into a major peak in late 2019 or early 2020. From a price perspective, really one of the key upside targets was recently hit as lumber surged into last month and doubled its 10-year trading range. It's kind of interesting to me that when you see a market that's remained in a trading range for an extended period of time, creating similar highs and lows during that trading range, when it finally breaks out, it will often double that range before it runs into really significant resistance. So lumber had traded between 150 and 400 since from January of 06 through September of 2017. When it finally broke above that range and gave a monthly close above 400, that range projection tool focused on 650 for its next objective. Lumber just attacked that level and is probably putting in a multi-month, maybe multi-quarter peak there. But in answer to your question, those types of geopolitical or fundamental moves usually corroborate the cycles, not dislocate them, except on maybe a very short-term basis. So the trade struggles between Canada and the U.S. Kind of play into those cycles.
Eric, thank you so much for chatting with us.
Thanks for having me back, Jim.
My guest has been Eric Haddock, president of InsideTrack.com and InsideTrackTrading.com. He was speaking to us from the Chicago area. Coming up from Japan, the Corbett Report's James Corbett, next on This Week in Money.
Glance Technologies owns and operates Glance Pay, a disruptive mobile payment technology now live in 16 cities in Canada and about to launch in the U.S. With revenues up 664% in the last quarter, Glance Technologies has the potential to be a worldwide leader in an industry projected to grow to $1.3 trillion in 3 years. Glance Technologies stock symbols are GLNFF in the U.S. and GET in Canada. Find out more at glancepay.com.
Hi, I'm Douglas Mason, President and CEO of Magnum Gold Corp. Inc., MGI on the TSX Venture Exchange. A 2015 drill program on the LH property intersected high-grade gold, including 16.9 meters of 13.58 grams and 11 meters of 20.66 grams per ton gold. A follow-up drill program is planned to further evaluate previously identified subsurface high-grade gold mineralization. Please visit our website at magnumgoldcorp.com.
This Week in Money is archived online at talkdigitalnetwork.com.
My guest is James Corbett, publisher of thecorbettreport.com and editorial writer for the International Forecaster. He's speaking to us from Japan, where he has worked and lived since 2004. Welcome back to the show, James.
Thank you for having me on. Always a pleasure to be here.
Major earthquake in Osaka. I hope you and your family are okay.
We are indeed. In fact, I didn't learn about it until one of my listeners sent me an email asking if I was okay. So on that note, I guess it's a good thing, but obviously not good for people in Osaka. I understand there are still some people in emergency shelters right now, certain areas still without power and without basic services. So it seems like it was a pretty strong one, and it hit the infrastructure pretty hard.
You're quite a distance away from there?
Well, it's an hour by Shinkansen, the bullet train. So, yeah, we're a couple 100 kilometers.
The deaths in that earthquake are all blamed on faulty construction, concrete walls falling on children and so on. Is that a concern in Japan when it comes to earthquakes?
Well, obviously that's a huge concern for any earthquake-prone area. So, of course, the Japanese construction industry is largely centered around the idea of earthquake resistance. And when we bought our wood-framed house here in Japan, the very first thing that we were demonstrated was here's an example of this wood-framed house on this earthquake machine generator thing where you get on the back and they generate a pretend earthquake, and you see how well the structure stands up to it. So, of course, the entire construction industry here is geared around that, but there have been scandals in the past involving construction companies that have cut corners saying that they included certain earthquake features, safety features in the building, which they did not. And these tend to be construction companies in Japan generally tend to be run by ex-police officers, police chiefs, and gangsters, often in collaboration. So it's a very shady business in a lot of respects, and I think there's some concerns about that. But having said that, in a strong earthquake in an urban area, I believe it was only 3 deaths that were reported, which it could have been a lot worse, I suppose.
Now, another thing that people in Asia, I think, are probably pretty worried about, trade war breaking out between China and the U.S. How would that affect Japan, and are they worried?
Well, I think it affects the entire globe. As historian Niall Ferguson pointed out, I believe he coined the term in 2006, Chimerica, which is the symbiotic relationship between China and the U.S. economy, has been the center of global growth and global trade for a couple of decades now, and really was the driving force behind global growth in the first decade of this millennium. So it is exceptionally important that we're seeing this fracture happening right now, and one can hope it is resolved quickly, because otherwise it's going to be a huge disruption to every economy in the world, including Japan. And I think we may just be seeing the beginning of it, because China itself has been using what it calls boycott diplomacy in the last couple of years since the South China Sea conflict took off, where, for example, they were boycotting Norway and Norwegian products for a while until Norway eventually had to relent. China has boycotted Japanese cars and minerals during a dispute over in the East China Sea. And they boycotted South Korean goods recently because of the anti-missile defense system, quote unquote, that they were installing there last year. And Kia and Hyundai, for example, have reported declines in sales over that, as well as a decline in tourism, because Chinese tourists are increasingly becoming more important to the economy. It used to be Japanese tourists going everywhere and being famous. Now it is Chinese tourists. So there are a lot of ways that China could hit back in this trade war, not just necessarily slapping dollar-for-dollar boycotts or sanctions on U.S. goods, because, of course, I don't think China has $200 billion worth of U.S. purchases to actually do a dollar-for-dollar boycott swap. But they do have other ways of hitting, and they can do things like stopping expansions of corporations in China. They can also do snap inspections of factories and things like that if they really want to become sticklers and basically bog down the manufacturing process. So there are ways that this could turn south very quickly, and as I say, since Chimerica has been the driver of global growth for going on 2 decades, I think it's very worrying for all around.
Could or would the Chinese government order its citizens simply not to buy U.S. goods, and would they go along with that?
Well, obviously, China has the Chinese government has the authority or the ability to do that, and I wouldn't put it past them, given the types of ways that they try to dictate the economy in general. So it's certainly possible, and if they put that into practice, you can imagine the types of executions that would take place for people going around those orders. So I imagine it would be effective in that regard, but I don't think they even have to go that far, because again, I'm not sure it's the consumerism of U.S. goods. Again, China doesn't have $200 billion worth of purchases from the U.S. to really affect an equal size boycott to what the U.S. is doing to China. But I think it would be more in terms of the ways that they crack down on corporations that are already within the borders. The Starbucks and Walmarts and Apples and Googles and Nikes and KFCs and everything else that have spread out throughout China in the last couple of decades. There are many ways that they can inflict pain on them. And I think it might be more realistic to imagine that as a strategy to try to get those corporations to get the Trump administration to go to the table and cut a deal with China to basically end any sort of practices that China would do to crack down on them.
Do you have any idea what the proportion of computer chips is that China sends to the U.S.?
I have no idea of the proportion or the ratio or the percentage off the top of my head, but I do know it is an increasing amount, and it is becoming important. And obviously, this is one of the things that the U.S. Government has been pointing to, the national security concerns around these. Of course, that is true, but it's, I think, on the other side of the coin, equally true for China and other countries to worry about Intel and other U.S.-based manufacturers being the manufacturers of most of the chips and things that are going into most of the electronics around the world. That is a national security concern on the other side of the coin, because of course, who knows what they're putting in, what backdoors for the NSA that will come out 20 years from now, that will suddenly, oh, hey, we were spying on you all along. Those kind of great reveals can certainly happen. So I think it is something that a lot of countries are looking into right now, and China is, as part of its vision, I believe it's called the 2025 vision or strategy, I'm not sure the exact nomenclature, but they are looking to become more independent and self-sufficient in terms of producing their own electronics, including chips and other things. So even if it's not an export issue, I think even just for internal domestic purposes, they want to greatly expand the ability to produce these types of chips and things for themselves.
We'll have more with James Corbett right after the break.
MGX Minerals is revolutionizing the new energy economy with patented lithium extraction technology, replacing traditional solar evaporation using low-cost, low-energy nanofiltration. The first system of this paradigm shift technology is currently being commissioned. MGX Minerals trades on the CSE, symbol XMG, the OTCQB, symbol MGXMF, and Frankfurt, symbol 1MG. For more information, visit our website, mgxminerals.com.
Hi, I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO, on the TSX Venture Exchange. Rainy Mountain's Brunswick property is located in the Rideout Shear Zone in Ontario, with grab samples running as high as 32 grams per ton gold. A follow-up drill program to test numerous targets located by recent groundwork is planned for early 2018. Please visit our website at rmroyalty.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. We're chatting with James Corbett. James, how are the Shanghai and Japanese exchanges holding up?
Well, there's been some slight upward movement in the last couple of days. As we talk right now, the Nikkei is off, I think, 0.04%. So not a lot of movement right now. I think the markets are holding their breath in collective anticipation of some of the moves that are coming in the coming days and weeks.
How much do Japanese people pay per liter for gasoline?
I'd have to look at my latest receipt, but I think it's something on the order of 146 yen per liter, something like that, which would translate into something around $1.50 or so Canadian, maybe $1.60, something like that. I'm not sure what the current exchange rate is. So slightly higher than Canada, but not as much higher as I expected. I did go to my hometown of Calgary earlier this year for a short vacation and noticed that prices were exceptionally higher than I remember them being the last time I lived in Calgary a couple of decades ago. Obviously, part of that is the new global warming, where pay our taxes to the sky god that the Alberta government has instituted recently. Part of it, I think, just the inevitable movement upwards in gasoline prices, no matter what the oil price is doing. And so that kind of shocked me. I would have assumed that Japanese gas prices would have been double what they are in Alberta, of all places, but apparently not.
And you're paying about the same as Vancouver, which has the highest gasoline prices in North America.
There you go, and I think that must be a sign of something. Perhaps the BC government might be looking into other ways to source their oil, just as Japan and other East Asian nations are. In fact, you might have seen the headline in recent days that apparently India is trying to put together an oil buyers club for East Asian nations, including not only India, but China, Japan, South Korea, who together make up, I believe, 4 of the top 5 oil importers in the world at the moment. And they are suffering under OPEC policies, including a special Asian, what do they call it? An Asian, I'm forgetting the term for it, but Asian premium, they call it, which is basically just an extra surcharge that OPEC countries slap on oil exported to Asia. The Asian nations are finally thinking about coming together to try to negotiate a better deal, as it were, with OPEC on that issue. And they have the buying clout to do so. So I think there might be more of an emphasis on that in the coming months, regardless of what's decided at the OPEC meeting this Friday.
Are you aware the Canadian government has taken over the Kinder Morgan pipeline between Edmonton and Vancouver?
I'm not following it that closely, but that seems like an interesting development.
And of course, when you're talking about an oil buyers club, that would be the perfect market for it.
Exactly right. Well, yes, I think certainly the Asian nations are looking to expand and to diversify their buying so that it's not simply from the OPEC countries. And interestingly, actually, one of the places that I think the Chinese, in particular, are hungry to get their snoot into is Iran. And you'll notice that immediately upon the announcement of the resumption of U.S. sanctions on Iran and the implication that European companies like France's Total will have to go along with that new sanctions regime, the Chinese state-owned petrochemical company, CNPC, said, we're more than happy to jump into France's Total's place in the South Pars gas field, the largest natural gas field on the planet. I think China is very much looking to these sanctions as a potential opportunity for them to get a greater trading relationship and perhaps broker a better deal directly with China, which these days could be, at least theoretically, facilitated and conducted completely in local currencies. They could be a direct yuan exchange at this point, the way that China has been setting up its ability to launch a petro-yuan. Well, this might be the perfect opportunity to really roll that out in a big way. Iran obviously highly motivated to sell their oil and to avoid the U.S. dollar, and China happy to buy oil and looking to avoid the U.S. dollar. It seems like a match made in heaven.
How is the Russia to China pipeline going?
I haven't heard any developments on that. As far as I know, it's still, I believe it's supposed to be operational at this point, although I haven't seen the latest developments on that. But that is an exceptionally important, I think, in terms of geopolitics and geostrategy and as geoeconomics, an exceptionally important moment. Basically the coming together of Russia and China, not necessarily because these two governments love each other or have any sort of fundamental desire to be wedded together, but simply that they are wedded together by being, for example, sanctioned and boycotted and trade warred with the Uncle Sam Empire. They find themselves driven into each other's arms, and I think the greatest encapsulation of that, the physical instantiation of that, is this pipeline that's physically connecting the countries, and it's a natural enough relationship, isn't it? Right on each other's border, one of the largest oil exporters on the planet, right next to one of the largest importers.
Should Russia and China be admitted to the G7?
I guess it depends on what the G7 wants to accomplish and what it wants to be. If it wants to be simply a talking shop for the NATO powers to talk big and to make big threats and rattle big sticks against their erstwhile enemies or their perceived enemies, then of course they would not want to let them into their little boys club. But if they do want it to actually be an organization that really is about the heart of global trade, then absolutely one would expect that China and Russia and India should be part of that conversation, being three of the largest and largest growing economies on the planet, and ones that obviously I think the 21st century economy, however it shapes out, will absolutely include those three economies in them. So if the G7 does not include those people at the table, then I think that's a huge part of global trade that they're basically leaving out there because they're trying to create enemies rather than to create trading partners.
Are they still projecting that China will surpass the U.S. economy soon?
The last time I checked, yes, that was on track. I believe as early as 2020, according to some projections. But those numbers always depend on what type of GDP you're using, whether it's PPP or other estimates. So there are various ways of calculating it. But at any rate, yes, there's no doubt that the Chinese economy is on track to be growing and to be surpassing the U.S. Again, maybe not on a per capita basis, but in terms of just China having an immensely large population that is starting to rise out of poverty, obviously it is going to overtake the U.S. economy at some point, unless something dramatic happens in the meantime, like a massive trade war that completely disrupts China's economy or something along those lines.
Who do you think can withstand a trade war better, the U.S. or China?
At this point, I would say the U.S. has the upper hand. I think China is absolutely, if these $200 billion worth of sanctions go into effect, China is going to feel the squeeze of that first. It is a question if China can survive this round of sanctions and don't have to go on bended knee to Uncle Sam and give them whatever they want. There is the real possibility that this might be a turning point for China in terms of the final motivation, the final nail in the coffin, I guess, in terms of actually going out and creating the types of markets that they need to supplant U.S. trade. One can imagine that this whole Silk Road, one belt policy that they're coming in, and the $1 trillion that they're spending to create all these markets. I mean, this is essentially what it's for, is so that they can start weaning themselves off of the U.S. as being the major export location. And so I think it's a war of attrition. And in the short term, I think the U.S. has the upper hand. In the long term, China might actually have the upper hand.
James, the Bank of Japan's interest rate policy, has it changed with the U.S. Fed now declaring it's going to keep hiking interest rates?
Yes, that's right. So the latest Bank of Japan pronouncement is that they're keeping their short-term interest rate target at minus 0.1%, and they are still pledging to guide the 10-year JGBs, the government bonds, yields to 0% or thereabouts. And so that's no substantial change to previous policy, which shouldn't be surprising. Of course, the target continues to be this 2% inflation that they are trying to get going in the economy, and they've been promising that essentially for a few decades now, and it's still never going to arrive. But there was signs earlier this year. There was some movement and some activity in the Japanese economy, and the BOJ issued a statement in April saying it looks like inflation might be moving to around 1%, which sounds pretty anemic. But hey, in this economy, I think that's actually an achievement. But now they are adjusting that downwards. They're saying that consumer price growth is now ranging from about 0.5 to 1%. And as a result, they're not going to tighten that monetary spigot. They're going to let the loose financial policy continue. Again, I don't think this is really surprising to people who are really following the markets here and what's really going on, and the fact that the BOJ has been propping up the economy for the last several years. They're going to need to prop it up even more so. I don't think there's any change in that because, again, unless we start seeing significant trickle down of benefits to the corporations in the stock market to the actual workers, I don't think we're going to see a large amount of consumer spending. And of course, that's what's going to be driving the inflation. So until that happens, I think we're going to continue to see this loose economic monetary policy from the BOJ.
Wasn't there just a big hike, or going to be a big hike in your sales tax?
There was a hike from 5% to 8% a couple of years ago, and that's on a sales tax essentially like the GST. That was a significant drag on the spending economy at that time. Things were slightly picking up, but of course, when the sales tax jumped from 5 to 8%, a huge dip in consumer spending was the result. And now, baked into the cake, I believe next year it is supposed to go up to 10%. But of course, the Abe government has been flirting with the idea of postponing that rise, which would be advised in an economy where you're trying to get inflation going and, despite your best efforts, are maybe going to achieve as much as maybe 1% inflation. One would think that they would not try to scuttle that by doing a policy like going to 10% sales tax. But then again, with one of the most heavily indebted nations in the world, at least in terms of debt to GDP ratio, the Japanese government has to do something to secure its debt, and of course, fleecing the taxpayer is always the way to go from the politician's perspective. So there are contrary incentives here for the government moving forward. So it'll be interesting to see whether or not they go ahead with that planned sales tax raise, or whether they put it on hold again.
With such a low birth rate, does the Japanese government give people incentives to have children, and are they thinking about maybe allowing immigration?
The incentives are not generally handled by the federal government here. It varies prefecture to prefecture, so the different prefectural governments have different policies, but a lot of them are using various baby bonuses kind of things and stimulus to try to encourage people to start having children. I don't think that has a very large effect, but at any rate, they are trying something. And there has been talk for a long time about the possibility of allowing more immigrants and skilled labor into the country. Obviously, Japan, I think famously, quite tight in terms of its immigration policies. There's been talk about loosening it up, but I would not expect that from the Abe government specifically, which is known, it certainly has a sort of more right-wing nationalist base that I don't think is quite ready for that type of change. I could be wrong. It would be interesting to see the way that plays out, but I don't think we're going to see a significant loosening in Japanese immigration policy in the immediate short term. In the long term, I mean, Japan's population is shrinking, so it's a question of how on earth, other than immigration, Japan will be able to deal with that.
Are cryptocurrencies becoming increasingly more popular in Japan? Because in South Korea, they're nuts about them.
Yes, well, I would say increasingly popular, certainly increasingly better known, and there is some visibility here for cryptocurrencies, but that visibility is not always good. And of course, there have been a couple of high-profile failures of exchanges here in the country, including, of course, the infamous Mt. Gox scandal of a couple of years ago. But now, and in fact, one of the larger cryptocurrency exchanges in the country, Bitflyer, is now under investigation of some sort from the Japan's Financial Services Agency. So they are coming under scrutiny, and that's being widely publicized. That's in the news here in Japan today. So again, a lot of the news about cryptocurrencies, the things that hit the mainstream, tend to be on the negative side. I think the Japanese are probably, I don't know, it's difficult to see the overall mood of the nation, but I think people are a little bit reticent given the amount of negative publicity that cryptocurrencies have had here over the last several years.
In Japan, is cash still king?
Absolutely, yes. It is a surprisingly cash-based economy, and it's surprising to me in a reverse culture shock now when I go back to Canada, and I find I can't even buy things with these paper bills that I have in my pocket anymore because, you know, no one will take a 50 at a gas station. No, that's crazy. Whereas in Japan, most purchases in most daily situations are done in cash. In fact, even some large-scale transactions are done in cash. We bought our car in cash, and that is not an uncommon thing here in Japan. So cash is definitely king. But there are moves afoot to make various contactless payment technologies more prevalent here, and it is starting to have an impact. For example, Subway, the Tokyo Subway has a card that you can store money on, and that's used at vending machines and things. So there are some inroads being made, but still cash really is king in Japan.
James, thank you so much for chatting with us.
Thank you for having me on.
My guest has been James Corbett, publisher of thecorbettreport.com. He was speaking to us from Japan. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Marianne and Pamela Aden, Eric Haddock, and James Corbett. And thank you for listening. If you have any questions for the show or our guests, you can send them to info@howstreet.com. I'm Jim Goddard. Now stand by for a company showcase update from American Manganese CEO and President Larry Reaugh.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of How Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HowStreet.com.
I'm Jim Goddard. I'm speaking with Larry Reaugh, CEO and President of American Manganese. Welcome back to the show, Larry.
Always glad to be on the show, Jim.
You're going to be busy in Las Vegas next week, and I'm sure it's not just at the gaming tables. What's taking place there?
Well, there's the Metal Bulletin Conference. We've been invited down there to serve on a panel. And I've also got several meetings lined up with some of the bigger battery manufacturers, so that'll be an interesting place to be. And it's interesting that we get invited to a lot of situations now and interviewed by companies and
publications around the world. And, this is, I'm really have an underlying, excitement about what's happening with the company. Something's going to break loose here pretty soon. And I can't really say when. I mean, right now we've got markets that are, suffering from, the tariffs that, Mr. Donald Trump has, been imposing, around the world. So there's a lot of uncertainty out there, but the reality is he always has an end game, and it always works out well for the U.S., and I expect the same thing to happen here. But in the meantime, we're working away at Cometco, and I know I've been remiss in getting a release out, but it's kind of like you have to make a decision. Are you going to put something out in a market that is like spitting on a fire? It's it's not going to help a lot. But we always have a lot of news. We have a lot of activity going on. And I'd like to mention all those in my podcasts. But what I do see happening is I do see that the demand for cobalt is not going to lessen. It's going to keep going up. I know that Tesla's talking about having a cobalt-free battery. And yet, on the other hand, Panasonic is talking about using up 30,000 tons in the next 3 years. So, Panasonic's their partner in their battery manufacturing in Nevada. So, there's a little bit of a contradiction there. And I would say that the reality is you're not going to get away from cobalt in the battery. The efficiencies and the things that cobalt contributes to a battery are not interchangeable. You can't bring something else in to do it. You can get a battery that'll work without cobalt, certainly, but it won't be as efficient. And so I'm not seeing a lot of worry on that part. I can tell by the interest in our process that a lot of that's to do with cobalt, and that's not lessening. So when we get down to Nevada, and I get to talk to some of the people and get their feelings on, where they're going, what's happening. One of the companies that I talked to out of China, which is one of the largest, said they've been all over China and nobody has a solution like we have, and that's a real feather in the cap. And it just means that it's only a matter of time till somebody makes a move to either partner with us or license a country or something that's going to involve a major shift in the aspects of the company and the credibility of the company, and I think that's going to happen sooner than later. It's I've been there's so much news coming out on batteries. They're talking 125 million by 2030. Wow, that's tens of billions of dollars worth of cathode material, and it's not going to come immediately on the table. And somebody asked me in an interview today for another publication, where are all the batteries going to come from? And to meet the demand. And I'm saying, it's been 8 to 10 years that they've been making these cars. Those batteries are right now ending up in landfills or being smelted, and that's a whole business in itself. So that's just going to keep increasing. 125 million in 2030 means that there should be tens of millions of batteries that have reached the end of life by that time. So you just have to look at the dynamics. It's one thing I liken it to is you drill for resources and reserves to build a plant and produce copper or gold or nickel or manganese or any of those products, and you're working with a diluted material, which means if it's 2%, then in order to get the 100 pounds out, you're going to have to process several hundred tons. So in our process, we're going to get 100 pounds out. We're going to have to process 100 pounds of cathode material, and that's the way you have to look at it. You have to look at it and say, hey, this is These resources are calculated on your calculator, right? And you know what the chemistries are, and you know what's in the battery, and you know if you got 100 or 1,000 or 10,000 of those batteries, that's what your resources are you're going to put through the metallurgical plant. So it's not as comprehensive as developing an ore body, and so we're excited here. It's certainly off to Las Vegas for that show. And, you know, people just have to remember that when I say we're invited. We're not just paying up to go to a show. And so that's kind of my message, and I'm hoping that I'll be in touch on the phone while I'm gone, but I'm hoping that there was some tangible results start coming from these conferences.
Larry, where are you traded, and how can people get a hold of your company?
We're traded on the TSX Venture Exchange under the symbol AMY. We're traded in the U.S. under the symbol AMYZF. And we're traded in Frankfurt under the symbol 2AM. And you can be reached at area code just 778-574-4444. You can send me an email at lreaugh, L-R-E-A-U-G-H, at AMYMN.com. Or you can go to our website, which is AmericanManganeseInc.com, and everything that we have is out there. People have to realize now that our patent is published, and so there's a tremendous amount of, if you try to go on there and download the patent, you'll find it's very slow. There's a lot of people looking at that patent. And so, you know, what we say can be verified.
Larry, thank you so much for chatting with us.
You're welcome.
The guest has been Larry Reaugh, CEO and President of American Manganese. I'm Jim Goddard. Our conversation took place on June 22nd.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated.